The Subcommittee on Oversight and Investigations will come to order. Today's hearing is entitled The Arbitrary and Inconsistent Non-Bank SIFI Designation Process. Without objection, the Chair is authorized to declare a recess of the subcommittee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the Chair for inclusion in the record. The Chair now recognizes herself for 4 minutes for an opening statement. The financial crisis nearly 10 years ago was born as a result of poor government housing policy that encouraged excessive risk-taking at taxpayer expense, as well as an inability of financial regulators to properly identify systemic risk and promulgate appropriate regulations. As a response to the crisis, Dodd-Frank doubled down on the failed approach and created a new super regulator with enormous power, the Financial Stability Oversight Council, or FSOC, tasked with identifying systemic risk. Additionally, Dodd-Frank enshrined too big to fail. It enshrined this policy in creating a new group of entities called Systemically Important Financial Institutions, SIFIs, who are subject to enhanced prudential standards by the Federal Reserve after an FSOC designation. If anything the financial crisis taught us, it was that relying on government regulators in Washington to identify and root out systemic risk will always end in failure. Instead, government regulators should come up with responsible regulations that enforce market discipline and ensure that institutions are not excessively leveraging themselves at the risk of taxpayers. The Choice Act, which this committee is currently drafting, provides such a framework not for deregulation, but for smarter regulation. Smarter regulation that will open up our economy while ending taxpayer-funded bailouts and imposing tougher penalties on those who commit fraud. For a long time, the actions and deliberations of FSOC were a mystery. Most meetings, nearly 2/3 conducted by FSOC, take place in executive sessions that are closed to the public, even though FSOC's governance documents encourage it to hold public meetings whenever possible. Additionally, FSOC meetings are closed to members of Congress as well as to regulators who are not FSOC members. And finally, there is very little documentation kept regarding meetings in executive session that the FSOC does convene, making it very difficult to determine the rationale behind FSOC decisions, which oftentimes have significant effect on the U.S. economy. For instance, reports show that the annual consumer cost of designating a non-bank financial institution as a SIFI could range from $5 to $8 billion. Yet FSOC additionally fails to conduct any cost-benefit analysis when designating a firm as a SIFI. For this reason, the Oversight and Investigations Committee began a review last Congress of the FSOC's designations of non-bank SIFIs by obtaining non-public internal FSOC documents and soliciting testimony from FSOC officials. After analyzing these documents, we released a staff report last month that found the FSOC's non-bank designation process to be arbitrary and inconsistent. First of all, the FSOC does not follow its own rules and guidance in many ways. The staff report also found that FSOC's analysis of companies has varied among firms eventually designated and firms that FSOC chose not to designate in considering different factors and weighing some factors differently among different companies. Ultimately, the staff report verifies what we have already known, in that Washington simply is unable to accurately identify and define systemic risk. Instead, government bureaucrats have acted very subjectively with very little transparency or accountability in exerting their power to the detriment of U.S. enterprises, their customers, and the economy in general. I now recognize the gentleman from Texas, the distinguished ranking member, Mr. Green, for 5 minutes.
Thank you, Madam Chair, and congratulations again on becoming the chair of the subcommittee. Madam Chair, in my opinion, a better title for this hearing would be Another Repeal Bill. Another repeal bill. We have seen the financial crisis that almost brought this country to its knees, the Great Recession. I think it does merit some reflection such that we can better understand the crisis that caused Dodd-Frank to come into being. In 2008, financial institutions fell by the wayside. In 2008, Countrywide was bought out. Bear Stearns bought out. IndyMac failed. Merrill Lynch bought out. Lehman Brothers bankrupt. AIG, $85 billion rescue. Washington Mutual failed. And then on September 29th of 2008, we had the greatest one-day decline in the stock market in history. Under the Bush request for a $700 billion bailout, at the time we were voting in the House of Representatives, we could see the votes as they were being tallied. And as the votes were being tallied, we could also see the stock market in the cloakroom. And as the votes were being tallied and the bill was going down, the stock market was going down as well. The stock market fell 777 points that day. Again, the greatest one-day fall in the market ever. That one-day decline caused billions of dollars to be lost. I remember how my constituents responded the day before we voted. My constituents wanted us to vote against the $700 billion bailout, as it was called. The calls were hundreds opposed to the bailout. Constituents were concerned about taxpayer dollars being used. After the bailout, the next day, the calls were hundreds, and they wanted to know why we failed to support the $700 billion bailout. Constituents have the luxury of being here today and there tomorrow. We in Congress have a responsibility to evaluate the evidence and come to reasonable and prudent conclusions. We did pass that $700 billion rescue bill, and that bill caused us to turn this economy around along with some other things. But I remember the auto industry, the big three were here. They needed help. My friends across the aisle said, let them fail. Many of them said, let them fail, let them fail. It was the responsibility of Democrats to stand and protect the auto industry, and we did. Democrats have been the party of yes, we can. Our friends across the aisle have been the party of no, we can't. The latest indication is what happened with health care. The party of repeal voted more than 60 times in one way or another to repeal the Affordable Care Act. Had the perfect plan. For 7 years, they've had a perfect plan to replace the Affordable Care Act. But when it was time to produce, when it was time to build as opposed to repeal, they could not produce. They could not replace. They are very good at repealing, very poor at replacing. So today, on the heels of the failure to repeal and replace, they could have repealed it, can't find a replacement. But on the heels of repeal and replace, we have yet another opportunity for them to repeal. They want to repeal the Consumer Protection Bureau, the bureau that is designed to protect consumers. They would repeal it. They now want to repeal the Economic Disaster Prevention Agency. It's called FSOC, but it's there to prevent another AIG. And it did so with GE. This bill will do more repealing than replacing. I'm against it, and I'm going to stand up for Dodd-Frank. I yield back.
Gentleman yields back, and the chair now recognizes the vice chair of the Oversight and Investigation Subcommittee, the gentleman from Colorado, Mr. Tipton, for 1 minute for an opening statement.
Thank you, Chairman Wagner. It's incredibly concerning to learn that the Council and its staff, while evaluating institutions for potential SIFI designation, failed to heed their own guidance, inconsistently applied criteria to firms, and fundamentally misunderstood what could cause financial distress in non-bank institutions. Further, it is disturbing to read that the designation process was often conducted on an ad hoc basis, with no clear guidance for FSOC or its staff and little hard evidence to justify designation decisions. These critiques do not come from the committee alone. Last year, the D.C. Circuit Court overturned a SIFI designation based in part on the failure of the Council to conduct a cost-benefit analysis. A recent GAO report came to similar conclusions, finding that the FSOC did not develop a process for identifying specific criteria to apply to analytical framework in evaluating companies. Yet again, we find regulators are quick to regulate but slow to analyze. I look forward to learning more in this hearing and about ways to reform the designation process to encourage a data-driven approach. Thank you, and I yield back.
Gentleman yields back. We now welcome our witnesses. Dr. Doug Holtz-Eakin. Dr. Doug Holtz-Eakin is currently the president at the American Action Forum. He has previously served as chief economist of the President's Council of Economic Advisors, as well as director of the nonpartisan Congressional Budget Office and as a commissioner on the Financial Crisis Inquiry Commission. With that, Dr. Holtz-Eakin, you are now recognized for 5 minutes.
Thank you, Chairman Wagner, Ranking Member Green, and members of the committee. It's a privilege to be here today to discuss the non-bank SIFI designation process, and I want to make 3 simple points and then look forward to your questions. First, as the staff report makes clear, there are deep weaknesses in the FSOC's designation process, but I'd emphasize that even if there was a good process, there's a mistaken emphasis on designating financial institutions as opposed to the activities and instruments that they operate. The second is that the designation process has costs. It's consequential costs for the firms, for their customers, and for the economy as a whole, and it's a mistake to ignore these costs in making the designations. And the third main point is that thus far, only insurance companies have been designated as non-bank SIFIs, and I would urge the committee to consider removing the FSOC's authority to do so, as it appears to be redundant at best. Let me expand on each of those. First, with regard to the process, as the committee knows, there are 3 stages in the designation process. Stage 1 consists of essentially a series of quantitative flags that the FSOC staff checks to see if a firm qualifies, and then it moves to stage 2, without the firm knowing it, to undertake an analysis that's based on size, leverage, interconnectedness, liquidity and maturity mismatch, substitutability, and the existing regulatory apparatus surrounding that firm. As the report makes clear, it is not at all obvious what weights are attached to each of these factors. It's pretty clear that they are applied differently to different firms and that there's anything but a systematic process by which firms are designated. And then in stage 3, it's an in-depth analysis of a firm, and as I emphasized at the outset, the focus on firms is a mistake in the FSOC to begin with, and thus it repeats this mistake in the final stage of its analysis. Second main point is that there are costs associated with this, and I would emphasize there are some economic costs. In the same industry, you'll have non-bank SIFIs designated for a higher standard of regulation and the costs that come with it. That produces an unlevel playing field for competition of financial services. It's also true that across the globe, U.S. firms will be at a disadvantage in competing for global markets. These are all important costs to consider. The Oliver Wyman study that was mentioned by the chairman indicates that a single non-bank SIFI designation could cost consumers somewhere between $5 and $8 billion, and that's a cost that the courts have indicated the FSOC should take into consideration, that it has simply failed to do so. And the last point is what should be the path forward. First and foremost, I think it's important for the FSOC to move away from a focus on designating firms as systemically important and instead undertake an activities-based analysis. It has indicated its interest and willingness to do so, but it now has an inconsistent approach across industries. That doesn't make a lot of sense. And with regard to the non-bank SIFIs that have been designated thus far, as I mentioned, they're all insurance companies. And if you look at the way the designation process has played out, essentially what they've done is taken these insurers and imposed on them a second round of essentially prudential safety and soundness type regulation Each of these insurers has a consolidated regulator at the state level. The report indicates that these regulators were not consulted adequately. Going forward, it looks as if the FSOC is essentially imposing simply a second layer of the same kind of regulation. It's not obvious that makes a lot of sense, and one might want to think about removing the FSOC's capacity to designate at a minimum insurance companies and perhaps rethinking the designation process as a whole. So I look forward for the chance to answer your questions, and I thank you for the privilege of being here today.
I thank the witness. Our next witness is Dr. Paul Kupiak. Dr. Kupiak is a resident scholar at the American Enterprise Institute. Prior to that, Mr. Kupiak was director of the Center for Financial Research at the FDIC, as well as chairman of the Research Task Force of the Basel Committee on Banking Supervision. Dr. Kupiak, you are now recognized for 5 minutes.
Chairman Wagner, Ranking Member Green, and distinguished members of the subcommittee, thank you for convening today's hearing. In my oral remarks, I will summarize my written testimony, and I will use a simple analogy from everyday life. On my commute home, I drive west on K Street. If I see a flash of light as I approach the 22nd Street underpass, I instinctively check my speedometer, remember the 25-mile-an-hour speed limit, and try to guess whether it was my car that triggered the speed camera. Now imagine that you are a CEO of a large, successful, non-bank financial firm. One day you receive an email from the FSOC saying that your institution is selected for a Stage 3 FSOC review. Stage 3 review, you ask? Who even knew the FSOC put us through a Stage 2 review? Your institution is profitable, well-capitalized, and growing. Your state regulators, and you have regulators in every state you do business, have given you a clean bill of health. Your staff has no idea why the FSOC picked you. Keeping now with my speeding ticket analogy, ask yourself, is there a speed limit for the institution? How fast is the firm actually going? How fast does the FSOC think the firm is going? Where can the institution find out answers to these questions? The situation becomes more surreal when you discover that there are no definite answers to any of these questions. The FSOC has the power to set individual speed limits for each and every non-bank financial institution under its jurisdiction. Moreover, the FSOC does not have to disclose to your institution's speed limit, even if you pay your white shoe law firm to make a formal request. They don't have to tell you. More troubling, the FSOC is the only agency authorized to measure the speed of non-bank financial institutions. And now, you as a target of a Stage 3 review, the FSOC scientists are already measuring your institution's speed using an unknown process and without any impartial witnesses present. If this nightmare of jurisprudence reminds you of a Twilight Zone episode, it's called the Dodd-Frank Act. I could mention specific troublesome details of the FSOC Stage 2 and Stage 3 designation decisions, and I do so in my written testimony, but the bottom line is the subcommittee's report shows the FSOC has no common methodology or uniform standards or assumptions that are used in individual firm SIFI designations. Each FSOC designation decision is an outcome of an ad hoc process. The lack of standardization means that identical firm characteristics can be and have been evaluated differently in different FSOC designation cases. An example will bring clarity to this problem. Say that the FSOC staff separately examines two firms with nearly identical characteristics. Let's call these two firms equally tall. They're Firm 1 and Firm 2. In examining Firm 1, the FSOC staff decides that Firm 1 is a safe firm. Because of its height, it can reach the high fruit on trees and it will never starve. The FSOC concludes that Firm 1 is not a SIFI. In a separate case in time, the FSOC examines Firm 2 and decides that tall Firm 2 is risky because it's at risk of being struck by lightning. FSOC decides that tall Firm 2 is a SIFI. If this designation process sounds unjust, it is. But can't Firm 2 appeal the FSOC's decision? Yes, it can, but remember, only some FSOC SIFI designation decisions are made public. There is no public record of FSOC decisions unless a firm is actually designated. So tall Firm 2 has no idea of the processes and arguments the FSOC used to evaluate tall Firm 1, nor does it even know that the FSOC evaluated tall Firm 1. Tall Firm 2 lacks the case law it needs to defend itself against an FSOC designation. While I have purposely omitted technical jargon, I have not exaggerated the deep, flawed nature of the Dodd-Frank FSOC designation process. I myself doubt there's a need for an FSOC SIFI designation process, but even if you would disagree with me on this point, I still doubt you would defend the current FSOC process as a legitimate way to go about making SIFI designations. The subcommittee has done invaluable work acquiring and analyzing confidential FSOC records that have made transparent the flaws in the FSOC designation process. The process is arbitrary and broken. It should be repealed or, at a minimum, fundamentally reformed. Thank you very much, and I look forward to your questions.
I thank the witness for his testimony and analogies that I can very much relate to. My apologies for your waiting in the rain to get in, Mr. Kupiak, but we're so glad that you are here. Our next witness is Professor David Zaring. Professor Zaring is an associate professor of legal studies and business ethics at the Wharton School. Previously, Professor Zaring was with the Washington and Lee University School of Law, New York University School of Law, and clerked on the U.S. Court of Appeals for the D.C. Circuit. Professor Zaring, you are now recognized for 5 minutes.
Thank you for inviting me. At Wharton, I study financial regulation, and I've written an article on the administrative procedure of the Financial Stability Oversight Council with Daniel Schwartz, who's a professor at the University of Minnesota. That article is forthcoming in the University of Chicago Law Review. And in my testimony on the procedures followed by the FSOC today, I want to focus on 3 points and make a few additional observations. First, the report prepared by the Republican staff of the Committee of Financial Services subjects the Council to a degree of after-the-fact review that is inconsistent with the flexibility Congress gave the Council in the Dodd-Frank Wall Street Reform Act. In that statute, Congress charged the Council with designating non-bank financial companies as systemically significant on the basis of, among other things, a 10-factor test. It did not specify how those factors should be weighed and emphasized that the Council should apply, quote, any other risk-related factors that the Council deems appropriate, unquote, to its designated decisions, in addition to those identified in the statute. The Republican staff report identifies portions of the written memoranda of the Council where it emphasized some safety and soundness factors more heavily than it did other factors. It also identifies cases where the Council considered the riskiness of a financial institution as a general matter as indicative of the risk the institution would pose when the economy was stressed. There is nothing arbitrary about emphasizing some factors more than other in such circumstances, nor is it arbitrary to presume that a non-bank risky in normal conditions would also be risky when times are difficult. Second, the report, while a real contribution into how the Council makes decisions, attempts to isolate particular aspects of the Council's analysis and makes arguments about inconsistency based on those aspects. But this sort of picking and choosing is really not consistent with the way that FSOC designations work. The designation decision is meant to be a holistic one, utilizing a number of different factors in a way that enables the Council to consider a full picture of any particular non-bank's position and of the effect that stress in that non-bank would have on the broader financial markets and greater economy as a whole. FSOC has its constraints. It can only act given a supermajority of its members. It can only designate financial companies, as that term is defined in Dodd-Frank, and it must revisit all of its designations annually. These constraints are real, and they cabin the ability of the Council to go rogue. But the factors that Congress told it to consider when it's making any particular discrimination decision of those institutions that fall within its jurisdiction are by necessity and sensibly broad and open to interpretation. Third, the Council itself has been given the responsibility for taking a broad view of the safety of the financial system, and it's the only part of the federal government with the power and the capability to do that. It's chosen to make designations in a manner that makes it possible to revisit those designations. Only the 3 largest insurance companies in America have been designated as systemically significant, as well as 1 large financing company. But it's important that the Council retain its flexibility to adjust its assessments of risk in the future. Second-guessing small portions of large decisions is inconsistent with the necessary flexibility that Congress gave the Council. Finally, the costs of designation are real, but they are easy to overstate. While GE Capital transformed itself in an effort to move away from designation, it is clear that there were business reasons to restructure the company anyway, and it's important to remember that FSOC rescinded the designation of that company. As the CEO of AIG has observed, designation, quote, just simply isn't a binding constraint on our capital returns and our objectives, so we don't spend too much time worrying about it, unquote. For that insurance company, designation has not been a burden, but rather a regulatory requirement that has not imperiled its business or its ability to make plans in the future. FSOC has only designated 4 companies. It's removed one of those designations. There are 2 designations that are currently active, and one of them is an extremely large insurance company, and the other is AIG, the company that collapsed so spectacularly during the financial crisis. There is no indication right now that more designations are contemplated. That does not look like arbitrary exercise of government power. Instead, to me, it looks quite cautious indeed. And it certainly doesn't look entirely subjective. With that, I thank the Council, and I look forward to your questions, and the committee, and I'll look forward to your questions.
Thank you, Professor Zering. Our final witness today is Mr. Alex Pollock. Mr. Pollock is a distinguished senior fellow at the R Street Institute. Previously, Mr. Pollock was with the American Enterprise Institute and was president and CEO of the Federal Home Loan Bank of Chicago. Mr. Pollock, you are now recognized for 5 minutes.
Thank you, Madam Chairman, Ranking Member Green, Vice Chairman Tipton, members of the subcommittee, and full committee Chairman Hensarling. To begin with, let me compliment the committee staff for their detailed, specific paper on FSOC's non-bank designation process. This embodies what I think is a very good analytical idea, namely to compare the FSOC evaluation memoranda against each other to measure their consistency, and the comparison shows they've been characterized by multiple inconsistencies and anomalies, as we all agree. The paper says these examples cast doubt on the fairness of FSOC's designation process. They do, but in my opinion, a more important point than fairness is that these observations cast doubt on the objectivity of the FSOC's work. As we know, a federal district judge, Rosemary Collier, ruled that FSOC's MetLife action was arbitrary and capricious, strong words, and that FSOC hardly adhered to any standard when it came to assessing MetLife's threat to U.S. financial stability. This sound and sensible judicial decision was appealed by the previous administration. I believe the current Treasury Department should immediately request the Department of Justice to withdraw the appeal, and that the Department of Justice should do so as soon as it can. Just today, the Treasury Department received a letter from the 10 members of the Senate Banking Committee, including the chairman, which says, in part, FSOC's process for designating non-bank SIFIs lacks transparency and accountability, insufficiently tracks data, and does not have a consistent methodology. So we seem to have the houses tracking together here. Going back to the FSOC designation, the independent member of FSOC, Roy Woodall, who is a true expert in insurance, voted against the SIFI designation of MetLife, objecting the analysis relies on implausible, contrived scenarios. Well, implausible, contrived scenarios are what we don't want. Ed DeMarco, a distinguished financial regulator, joined Mr. Woodall's earlier dissent on Prudential and also pointed out that key FSOC arguments lacked evidence. Well, we certainly do want evidence. Was there a substantive discussion among the members of FSOC about these issues? I am told that there was not. But the whole point of FSOC is supposed to be a committee for deliberation and development of insights together in discussion. I directly asked one former senior FSOC insider from the previous administration if the meetings of the FSOC members had ever produced a new insight into financial issues. After thinking a minute, he gave me a candid answer, no. The underlying problem, it seems to me, is the structure of the FSOC itself. So the procedural issue leads us to a bigger structural issue. The shortcomings of designation point us to What about the FSOC itself? Well, we know they're primarily a group of individuals, each from a regulatory agency, each with turf to protect from intrusions by the others, and a regulatory record to defend. At the meetings, they bring along helpers and allies. At the FSOC meeting that approved the MetLife SIFI designation, there were, according to its minutes, 46 people sitting around the room. I don't think they had a serious give and take substantive discussion with 46 people. And the composition of the FSOC makes it a necessary political body. That's why it's easier to see why FSOC's evaluations tend to make inconsistent analyses. It's because the decisions made are inherently judgmental with inherently subjective elements. We might call those holistic, Professor Zering. What it means is FSOC actually acts as a little legislature, and I think that's a bad idea. Madam Chairman, you mentioned Fannie Mae and Freddie Mac, which are obviously systemically important and without question systemically extremely risky. But Fannie Mae and Freddie Mac are never studied as possible SIFIs by the FSOC staff, in spite of the fact that they are obviously SIFIs. Why not? Because the Secretary of the Treasury controls who gets studied and would not allow the staff to look at Fannie and Freddie, which are pure cases of the government shielding creditors and counterparties from losses, not only as a hypothetical, but as a vast fact. And that's something that the Dodd-Frank Act instructs FSOC to eliminate, protecting creditors in this fashion. So FSOC needs some immediate actions on their procedural issues, as we have discussed, but it also needs structural reform for the longer term. Thank you very much for the chance to share these views.
I thank all four of our witnesses, and without objection, the witnesses' full written statements will be made part of the record following their oral remarks. Each member of the subcommittee will now have 5 minutes within which to ask questions. Chair now recognizes herself for 5 minutes. Dodd-Frank, in directing the FSOC to identify systemic risk, tasked a number of prudential financial regulators, such as the Federal Reserve, the FDIC, the OCC, as members of FSOC. Mr. Pollack, since you arrived first, I'd like to first start off in asking how these financial regulators have fared in the past in identifying risks to the financial stability of the United States.
Thank you, Madam Chair. And of course, they haven't done very well. I was just reading two wonderful quotations from the then chairman and the current chairman of the Federal Reserve from the end of 2007 and January 2008, forecasting that there would not be a recession. At that point, of course, as we know, the recession had already started. And we have numerous examples of regulators failing to see the disaster that was coming, as other people, other forecasters, of course, failed to see it. Because the financial future in particular is inherently uncertain, we certainly can't put faith in any bureaucratic bodies to protect us from that. Personally, I prefer to put faith in higher capital.
I thank you. Dr. Holtz-Eakin, I'd like to follow up on this as well in asking if there is a simple way to measure systemic risk.
There is not. In fact, there's no agreement on exactly how to measure it, what it looks like, and if you can't measure something, you can't manage it, and it's far from obvious what the FSOC is trying to do in those circumstances, and I think that's a fundamental flaw in the entire idea behind the FSOC.
If you can't measure it, you can't manage it. How then can Congress evaluate whether the FSOC is properly performing its job?
The only way to evaluate the FSOC would be to get some transparency about its procedures so that it at least does whatever it's doing the same way every time and to everybody. And all the evidence we have thus far is it is not doing that.
Another issue I believe that impedes Congress from evaluating whether FSOC is performing its job is simply the lack of information and transparency from the Council. From our previous work on this committee, we've known the FSOC to be one of the least transparent federal entities, providing very little oversight for Congress and the public into the deliberations of council meetings. These are quick, and we'll switch it up. Dr. Kupiak, I'll start with you. It wasn't until the release of this committee staff report that we started to actually see the rationale, and in many instances, lack of rationale, for the decisions made by the FSOC Council. Dr. Kupiak, should the FSOC be made more transparent?
Oh, I think the subcommittee report makes it very clear that transparency is long overdue. I think from the designations, from the public documents we saw associated with the various designations, there were strong suspicions that the FSOC decides on a designation and kind of makes up a story afterwards to justify it. It's a sort of an attempt in writing financial fiction. What I think we've seen with the subcommittee's report, where it actually goes through and analyzes the Stage 2 documentation that was not publicly available or known to anyone, is in fact, this is true. This whole characterization that it's an after-the-fact story made up to justify a decision or a non-decision to designate, I think comes out very clearly in the subcommittee report.
Let's go down the line, starting with Dr. Holtz-Eakin. All four of you, yes or no? Should the FSOC publicize its internal processes?
Yes.
Yes.
No.
Yes.
Should FSOC allow observers at its meetings, such as participants from member agencies or Congress?
Yes.
Absolutely.
No.
Strongly yes.
Should FSOC keep detailed minutes and transcribe their meetings like the Fed's Federal Open Market Committee does?
Yes.
Yes.
No.
Yes, it would be a good idea.
While I thank you all, while our committee is considering broader reforms and changes to the structure and powers of FSOC, what are some other actions that Treasury Secretary Mnuchin could make right now at FSOC to bring more transparency and accountability to its action? Dr. Holtz-Eakin?
I think the FSOC showed some improvement with its 2015 guidance, and Secretary Mnuchin could, pursue greater transparency and greater consistency in its actions.
Dr. Kupiak?
I think since systemic risk is such an elusive construct and really can't be identified, in my opinion, that the FSOC ought to move towards specific thresholds and evaluate firms along guidelines that are observable and can be defended or not.
Thank you. Thank you. My time has expired. The chair now recognizes the distinguished ranking member, Mr. Green, for 5 minutes. Pardon me, Mr. Cleaver, for 5 minutes.
Thank you, Madam Chair. And Mr. Green, Mr. Kupiak, I do analogies in my real life quite a bit, and so I was struck by your analogy of the traffic light catching somebody for speeding, or getting a ticket for speeding. And then you compare that with a non-bank financial firm suddenly getting a notice of stage 3 evaluation. Did I restate your analogy correctly? Are you aware that the Council published supplemental procedures with 17 changes in order to increase transparency in the designation process? Are you aware that they did that?
Yes, I'm aware that following testimony in the Financial Services Subcommittee, which was very critical of the FSOC's process, they did publish some changes and try to improve transparency, yes.
But no matter why they did it, right?
But they didn't do it out of their own goodwill in the matter.
You don't know why they did it. You have no idea. You have absolutely no idea why they did it. All we know is that they did it in 2015, and you said transparency is long overdue. 2015. Now, how do you know that you know why they did it?
I testified in the hearings that led up to the difference. So maybe I'm mistaken, but that would be my judgment.
Well, okay, that's fine. With this, that's judgment. I like judgment, except if it has day on the end of it. But the point I'm trying to make is that you're calling for transparency, and we've had transparency, and that's just a little confusing. Do you know? Have you looked at the website?
Excuse me?
Have you looked at the FSOC website?
Yes, sir. I've read the designation decisions.
Yes, and you also
and the
know
court and the court cases, in MetLife court case.
And you know they detail the criteria they use in stage one.
Yes, in fact, I was involved in stage one designation process when I was at the FDIC as the head of the economics group there.
But you know that that's on the website, don't you?
Yes.
Okay, I don't understand. Pants on fire. Let's evaluate when. Which was your testimony. Then you're now admitting that that they have transparent. Professor Daring, can you confirm that FSOC announced that they will notify a company within 30 days of activating a review in stage 2?
That's right. They have this elaborate three-stage process, and if they take a company into the third stage of that process, the company has every opportunity, and so far as I know, has taken every opportunity to interact with the council in either fighting or responding to an inquiry by the council that suggests that the stage 3 review is beginning. That includes meeting with council members, turning over documents to the council. The council vote is public, of course, after which comment and a hearing can be, or the tentative decision is public, of course, after which the designated institution can provide comment. There's an opportunity for a public hearing. I think there's a great deal of process attached to this designation decision.
And then in stage 2, Dr. Kopegny, do the companies have the opportunity to present information to the council?
They do after stage 3. In stage 2, the council tries to figure out which companies to ramp up to this adversarial determination.
I'm trying to figure out this lack of transparency, just that people are going into bunkers to do business. I don't understand this.
I agree. To me, the council is providing the very few institutions that it has designated with a strong amount of process.
Thank you very kindly. You're back.
Gentleman yields back. The chair now recognizes a gentleman from Colorado, Mr. Tipton, the vice chair of the subcommittee, for 5 minutes.
Thank you, Chairman. Dr. Kupiec, when the FSOC is conducting an assessment on the institution's potential for creating systemic risk, does the council consider the existing supervisory process regulating that entity?
They are supposed to consider the supervision and regulation in place, but I would say the designation decisions that have been made thus far do not take account of those in any way, any serious way.
Thank you. Well, how were the current non-bank SIFI firms supervised them prior to their designation?
Well, AIG was actually supervised by a primary federal regulator, the Office of Thrift Supervision, actually, and state insurance commissioners in all the states that the AIG does business. And the other insurance companies, all their insurance subsidiaries are supervised by the state insurance regulators, and some of the designated SIFIs had at one time bank subsidiaries who were supervised by both state regulators and a federal regulator. It varies by case by case.
Right. Now, have these regulators, have they raised issues about the financial health or safety of the current SIFI non-bank institutions prior, during, or after their designation?
The short answer is no. I'm not aware of that. AIG, of course, did get in trouble in the financial crisis, but I am not aware that it was under any kind of warning signs from the Office of Thrift Supervision. I think they basically weren't really looking at AIG. They were the ones responsible for the financial products group in London, which was actually the part of the firm that wasn't supervised by a state insurance regulator, and that's the part that caused the troubles.
So, just to be clear, a whole series of regulators are lined out, going through. They've raised no concern about the health, the safety of the institutions that were in place going forward, but now with the FSOC going in, we're seeing them choosing to designate.
Yes, and the designations for the insurance companies, the way the FSOC makes it, is very unusual in that it treats the products of insurance companies as if they were bank deposit-like liabilities that could be withdrawn at that people would line up and withdraw the residual value of their life insurance policies or whatever, and they're not bank deposit-like products, and there's really no evidence that there have been any institution-wide runs on all the various subsidiaries at any time in the past. So the story is a very fictional story that the FSOC uses to make the designation.
Now, did the FSOC do any sort of cost-benefit analysis as part of the SIFI designation process?
None that I'm aware of, and none that they specifically state in public documents. And their opinion is that they don't have to. Is their opinion in the legal case that they're not required to make any cost-benefit analysis.
In your opinion, does this undermine the credibility of the FSOC's conclusions if fundamental aspects of the assessment process are flawed and the impact of the SIFI designation was not extensively studied prior to the beginning of the designation?
I don't think the FSOC or anybody has the capacity to scientifically identify one firm as a SIFI and another firm isn't a SIFI. I do not think the science of statistics or economics or finance is sufficiently advanced that you can definitively separate out firms into those that are a source of systemic risk and those that aren't until after perhaps they blow up. But ahead of time, I don't have any confidence that regulators have that ability or any academic or any person anywhere at this point in the science of risk measurement.
Thank you. Mr. Pollack, I gather you agree with Mr. Woodall's conclusions in regards to designation of MetLife and Prudential. Why is that really important? Is it important to be able to have somebody who actually has experience in an industry playing a role in these designations?
Congressman, I think to have somebody who actually is an expert in the industry is extremely important, and Mr. Woodall's dissents, in my opinion, were very articulate and substantive.
Well, once a firm is designated as a SIFI, they're overseen by the Federal Reserve Board. How much experience does the Federal Reserve have in insurance regulation?
Very little, and it certainly by no means could be considered an expert.
Thank you, Madam Chair. My time has expired.
Gentleman yields back. Chair now recognizes the gentleman from Texas, Mr. Gonzalez, for 5 minutes.
I'll be yielding the balance of my time to Representative Al Green.
Thank you for yielding, and thank you for being such an outstanding member of the committee. We greatly appreciate your service. Let's start with Mr. Aiken. Is that correct, sir?
Holtz-Aiken, yes.
All right, sir. Thank you. Sir, you talked about the cost of designating a bill as a SIFI, and I think that's worthy of consideration. But what about the cost of not designating a entity as a SIFI? AIG was not designated as a SIFI, and AIG cost the country a good deal of stress, $85 billion rescue effort, and it was paid back, by the way. Don't you think that the cost of not doing it is important as well?
If we could, as a matter of science,
well, let's examine if we could. Because we can't do it perfectly, we should not do it at all, seems to be your thought processes. But it seems to me that FSOC is working. FSOC, by the way, is the Economic Disaster Prevention Agency. It's in business to look over the economy and to spot these AIGs. By the way, Mr. Kupiec, was, how was AIG regulated?
AIG was an international insurance company.
Okay, it was an insurance company. You seem to have some concern about insurance companies being regulated. AIG is the ultimate example of why we have to regulate some of the insurance companies. Some of them, not all of them, some of them. Let me
AIG
move on.
was
Excuse me,
regulated.
I'm going to my next witness, if I may, please. Mr. Zaring, is this Economic Disaster Prevention Commission, if you will, is it working?
So far, since the passage of Dodd-Frank, we haven't had a financial crisis, despite the fact that around the world there's been plenty of financial turmoil. There's every sense to believe that financial institutions, especially non-banks, are more solvent and have better protections in place for a crisis. And I think a lot of that has to do with the fact that they know that FSOC is watching. So FSOC has been very cautious about its designations, but because it has the power to reach out and get risky behavior by financial institutions, it's had a salutary effect on those institutions as a whole.
And can you give an example of not only designation, but also de-designation? Because FSOC has the ability to designate, and it has the ability to allow a company to take the necessary steps to eliminate risk and de-designate. Can you respond, please?
That's right. In the case of GE Capital, the firm was designated and it was engaged in lots of marketplaces, which meant that a lot of its financing was very runnable. Financing and insurance companies also do practices like securities lending and get into markets where the financial assets at stake in those markets are runnable as well. So GE Capital transformed itself from an institution that relied on these runnable assets for financing into a much more stable institution that did not, and the council responded by revoking the designation. It has an annual responsibility to review every designation for revocation, and there is every indication that FSOC takes that responsibility very seriously.
As a matter of fact, looking at GE Capital, they were into consumer credit. They had a consumer credit arm. They had a commercial lending business. They had a real estate assets business. They had online deposits. They had an asset management arm. They had hotel financing. They had restaurant financing. They had transportation financing. They had healthcare financing. They were all over the place.
That's right. And I might add that it didn't seem to me that GE Capital was well supervised by any regulator, given all these various and potentially risky businesses it was in. FSOC provided a backstop that I think was an important source of stability in the way that it supervised GE Capital and persuaded it to change its business in, I think, ways that were good for the American economy.
Does that cause you to hearken back to AIG and how it was regulated and supervised?
Big companies like AIG can get involved in new and creative markets with levels of risk that they don't really understand. FSOC's a barrier against that kind of thing.
Thank you. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Tennessee, Mr. Kustoff, for 5 minutes.
Thank you, Madam Chair. Dr. Holtz-Aiken, thank you for being here this morning, and thank you for your past public service. As we've seen with the implementation of Dodd-Frank and the creation of FSOC, has been authorized to notice and implement final rules to determine whether a non-bank company will pose a threat to the financial stability of our country. Undeniably, this authority has allowed for FSOC to impose guidance on what it considers its own definition for what actually constitutes a threat to financial stability. A definition, in my opinion, which is inconsistent in their rulemaking, and more specifically, their designation of systematically important financial institutions. These independent agencies are created by Congress and staffed with presidential employees. As such, we expect these individuals to create rules and regulations objectively and independently. Do you believe that the FSOC is capable of acting as an independent regulatory agency?
It could be a better regulator in the sense of having processes that were more systematic, that were uniform, that were transparent, and where you could have objective criteria that they sought to meet, I do not think that the science exists to fulfill its basic mission, which is to identify systemic risk and reduce it. As you know, I served on the Financial Crisis Inquiry Commission. I think all the time, in the narrative of that crisis and in the events as they unfolded, had there been an FSOC, would it have known how to stop it? And the answer is no. It would not have. It is the activities that went on, the interconnectedness of those activities, not just among firms, but across the globe, that is the most striking feature of the crisis. That took place in many different regulatory environments. None of them were smart enough to foresee the forces that combined to produce the financial crisis. And FSOC would not have been smart enough either.
As a follow-up, if I could, last year, Chairman Hensarling introduced the Financial Choice Act, which would eliminate the FSOC's ability to designate SIFIs. What additional reforms would you recommend to this committee that would remedy the FSOC's unchecked authority to make these designations?
There's several levels of, I think, reforms. One are the ones that we've mentioned several times about the process by which it operates, making it more transparent, more uniform, a clear exit ramp from SIFI status, and making sure that the burden doesn't fall on firms that are too small. The second would be limiting its scope to designate non-bank SIFIs. I, for example, think that in many cases, all we're getting out of the regulation of these insurance companies is a second layer of what the consolidated state regulators are doing anyway, and they're ignoring that. So I don't see why we should do that. And then the third level of reform, I think, would be to really pull back on its ability to do this at all. It's been given a mission that it can't fulfill. It has enormous authorities and can impose large costs in the economy. That strikes me as a very bad regulatory arrangement and ought to be scaled back entirely.
Thank you very much. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from New Jersey, Mr. Gottheimer, for 5 minutes.
Thank you. I yield my time to Mr. Cleaver, Madam Chairwoman. Thank you.
Thank you very much. I want to kind of keep going in the direction I was going. When this financial crisis hit, I was sitting when Mr. Hank Paulson, Sheila Bair from FDIC, Bernanke, Mr. Ben Bernanke, Chris Cox from SEC. I was in here today, it was late in the day, sitting around that next to that empty seat on the end. When they came in, half the members were gone already to tell us what was happening to the economy. I was in here. I get the impression that there are those of you on the panel who would suggest we should have just walked out and said, I hope things turn out on Monday. We were warned that if we didn't start acting, that the U.S. economy, by the time the Asian markets opened after the weekend, that the world economy could very well fall into shambles. Or Mr. Holtz asking, are you guys saying we should have said, well, whatever happens is fine. We want the free market to just kind of do what it does and see you later and walk out and catch our planes? Because I was in here, and I guess sometimes I get disturbed when people, well, you guys should have done this and you should have done that. I was in here. I know the tension that was going on. I saw what was happening firsthand, and so I'm just curious. If you had been sitting in here, what would you have said to Hank Paulson, who said President Bush asked him to come over and said, well, go back and tell him, let's let the free market just kind of roll.
I've been on record as saying it would have been irresponsible for the Congress to do nothing. And we saw that in the aftermath of the first failed TARP vote, significant economic damage.
I watched that as well. I watched it
Yes.
in real time going down on the TV in the cloakroom.
That's different from saying I think the response was the most effective response possible, which I don't think the TARP turned out to be. I do think it's important to recognize that the Federal Reserve was the single most effective response to the financial crisis. It essentially followed the oldest central bank's playbook and was remarkably creative in lending against any reasonable collateral and flooding markets with liquidity. That's always been the recipe in the financial crisis. They did it again, and then the speed with which financial markets recovered is attributed, I think, primarily to that response.
Since that legislation was passed, how many banks have been designated, non-banks, have been designated as SIFIs?
There have been a total of 4.
Like 1, 2, 3, 4?
Yeah.
Yeah. This is just amazing. This is just amazing. Mr. Zirin, can you explain why we're talking about this traffic light getting a ticket for speeding. What is...
I agree with you. There's no sense that the council is going rogue here with only 4 designations in 6 years of existence. And then, of course, it rescinded one of those designations. The reason I don't think a traffic light camera is inapposite is precisely for the reason that Dr. Holtz-Eakin suggested. This Financial Stability Oversight Council occupies a precautionary role in American regulation because we do not know where the next financial crisis will emerge from. But we do know that the downside risk, as you've just stated, Congressman Cleaver, is extremely high and extremely serious. It makes sense to create an institution that can take precautionary approaches to the possibility of that extreme downside risk coming in some way that we don't precisely know will occur. And that's what FSOC does. The fact that financial crises are not reducible to some sort of arcane or particular mechanical measure, it seems to me is a good reason to have a regulator to take the broad view that FSOC has.
Mr. Kupiak, if you rethought your analogy, would you rather have a flashing yellow light?
No, sir. I think my analogy is completely apt, and I would say that the FSOC has done nothing on regulation. They've designated 4 firms. The Federal Reserve Board has not promulgated any regulations, especially for insurance companies, and I fail to see how anybody would argue that just merely designating 4 firms has made the world safer against a financial crisis. As far as I can tell, they've done nothing. The costs caused GE Capital to jettison what had been a very profitable line of business over many years. I don't see why destroying a profitable, well-run firm and making it split apart is a success. I would disagree with all those things that were said.
Gentleman's time has expired. Chair now recognizes the gentlelady from New York, Ms. Tenney, for 5 minutes.
Thank you, Chairwoman Wagner, and I thank the panel for being here today on this very important issue. You've heard from my colleagues about the inconsistent arbitrary designation of SIFIs, and for the record, I just want to say that it's systemically important financial institutions because it just sounds so vague and bureaucratic, and I think that instead of saying SIFI and FSOC, I think we need to let the public know just exactly the nature of the vagueness. But the costs associated and increased burdens that are involved. I'd like to touch on a couple of off-ramp strategy, specifically for the non-banks, systemically important financial institutions. Got to get it all out there. Dr. Holtz-Eakin, in your testimony, you pointed out that FSOC / Financial Oversight Stability Council, another vague title, only designated insurance companies as non-bank SIFIs, and you believe they provide no additional financial stability. FSOC has made it their mission to identify threats to America's financial stability, but when they are blindly designating companies based solely upon inconsistent and arbitrary standards, that is a clear indication of poor structure and management in the non-bank SIFI designation process. Again, more vagueness. I think you make a fair argument by calling for the removal of FSOC's authority to regulate those non-bank financial institutions because these companies are already being heavily regulated at the state level. And I can speak for that as a former state assembly member who actually voted no on the consolidation of the banking and insurance agencies into one financial services agency in the state of New York, which has just caused more regulation and just evidence of the incredible oversight and regulation that we already have in New York State. But let me add that FSOC has been criticized for failing to provide clear standards, again, we're back at vagueness, for de-designation and for failing to provide affected companies with a clear path or exit ramp of actions the company could take to change its business to get the designation removed. So let me address my first question to Dr. Kupiak. If there is no clear standard for designation, how can there be a clear standard for de-designation? Or to put the question another way, does the fact that FSOC cannot clearly state what will lead to de-designation mean that the entire designation process is arbitrary?
I think that's an accurate statement. To the best of my knowledge, the FSOC does not give the designated firms clear guidance on what they would have to do to not be a SIFI. The designation documents themselves paint a very arbitrary and fictional story about how the FSOC gets into trouble. There's no way that you can, based on those stories and narratives, decide how you would change your business to escape that narrative. So I think it's very, very true that there is no off-ramp, no specific off-ramp. GE negotiated one somehow over time, took a very drastic step by getting out of the financial services industry entirely. The FSOC couldn't regulate it anymore. It fell below the 85% threshold. So it wasn't like the FSOC did something. GE did it. They got out of the financial services business, period, and the FSOC fell below the 85% threshold, and the FSOC couldn't designate it anymore. So I wouldn't say that was a great day in the FSOC history where they de-designated a firm. The firm did it themselves, and it was very costly and painful.
Thank you. Let me follow that up. So would you then say that do you trust that FSOC has been fair in evaluating the de-designation process?
No,
evaluating companies in the de-designation process?
No, I think the subcommittee report does a very big service to the public by making public the decision process for the stage 2 non-designation decisions, which you couldn't know without the committee getting a hold of those documents, and even with the very heavily redacted discussion of it, we can tell that the FSOC makes up a story and an ad hoc analysis for each firm on any given day, and they're never consistent, and there's no set standard that they follow.
Thank you. Dr. Holtz-Eakin, do you think that, do you agree that we'd have to have a complete overhaul of the SIFI process or designation process? Or how do you
I very much do.
Okay.
From the sort of arbitrariness of the analysis from firm to firm, from the ignoring of the experts in the insurance business during the designation of insurance companies, and from, I want to emphasize the point that Dr. Pollack made at the outset, which is how can you not at least look at Fannie Mae and Freddie Mac, who are the living, breathing definition of dangerous financial institutions and have proven it through time.
Gentlelady's time has expired.
Thank you. Thank you very much. I appreciate it.
The chair now recognizes the ranking member of the full Financial Services Committee, the gentlelady from California, Ms. Waters, for 5 minutes.
Thank you very much, Madam Chair. I thank the panelists for being here today. One of the main arguments that opponents of the FSOC make is that it simply has too much power, in Congress through Dodd-Frank has given the agency unlimited authority to determine which non-bank institutions are systemically important. However, directly included in Dodd-Frank are 10 specific factors that the FSOC must consider prior to designating a firm as systemically important. Can you discuss, and this is for Professor Zarin, can you discuss these factors and how they serve as a check on FSOC's ability to declare any institution a SIFI?
That's right. The factors that Congress gave it give it some flexibility, but also some instruction as to how it is supposed to make particular designation decisions. And of course, FSOC can only designate companies that qualify as financial companies. It can only designate them upon a supermajority vote, and it can only designate them after going through this 3-stage process at which the companies have time to respond. FSOC has to find that a firm could pose a threat to the financial stability of the United States, either in the event of material financial distress or due to the nature, scope, size, scale, concentration, interconnectedness, or mix of its activities. Those factors and the other ones that it has considered are guidance to FSOC as to what it should consider. And I don't think it means that FSOC is arbitrarily applying that guidance if they emphasize some factors over other factors when it comes to figuring out whether a particular institution poses a great deal of downside risk.
So this discussion about being arbitrary with unlimited authority just does not ring true. Based on the fact that there are these 10 specific factors that you just helped to explain. Now, doesn't the fact that the FSOC has only designated 4 non-banks as SIFIs since 2010 confirm that the FSOC is not arbitrarily imposing SIFI designations on all non-bank financial firms, but instead acting responsibly to protect taxpayers and our financial system from another devastating financial crisis? Mr. Zari?
I agree, Congresswoman. I very much agree with that. FSOC has not designated any more than 4 institutions. It has only designated 4 institutions, and those designations, once again, made a great deal of sense. They were the 3 largest insurance companies in the United States, including AIG, which was the insurance company that collapsed during the financial crisis, necessitating a massive and painful bailout. If that's not systemically risky, then I'm not sure what is. And then the final company that was designated was GE, and as we've discussed earlier, GE was poorly regulated by any other regulator, was engaged in many different markets, had a real risk of runnable financing that creates systemic risk. At the very least, we know that. And so was accordingly designated and changed its business accordingly. So I think that FSOC has been cautious in its designation power use. It's been clear about the kinds of things it's worried about. It only hasn't tried to create some sort of a standard which informs some non-bank financial institutions that they will never be designated, thereby encouraging them to take on systemic risk after they get a free pass.
This may not be a fair question, but why is it opponents of FSOC have forgotten the lessons of AIG? Can you speculate on that?
To me, it's a real concern. So AIG had a AAA credit rating, and it's not that the regulators were the only people to miss its riskiness. So were its investors, its managers, and the broader capital markets as a whole. So the idea that we can rely on the free market to the extent that one exists in financial services to begin with to uncover risks like AIG, I think, is naive. What AIG did, in addition to its runnable securities lending business, was get involved in a new industry or a new business, writing credit default swaps, where it didn't understand the risks posed in that business. That's the kind of thing that a regulator is supposed to be able to step in and caution a firm that it should pay attention to. And I think that forgetting the lessons of AIG is unwise to the extreme.
Thank you very much, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Michigan, Mr. Trott, for 5 minutes.
Thank you, Chairman. Thank you, the panel, for being here. Professor Zering, so what happened in the MetLife case? You've been singing the praise of FSOC all morning, and what happened there? Is it just some rogue judge that doesn't understand, or what happened there?
I disagree with the judge's decision in that case. And I think in that case, the judge made a decision to require FSOC to conduct a cost-benefit analysis that is plainly not required by the language of the statute. And that doesn't really make sense for FSOC as a whole, and here's why. I'll be brief. I know you have more questions. But the costs of designation, and that's something that's pretty easy to calculate. But the benefit of designation is the goal is to avoid a financial crisis or a calamity. It's really difficult to quantify that, though it is a real benefit. So FSOC does apply a cost-benefit analysis, but it doesn't apply a quantified one in the way that the judge seemed to prefer, and I disagree with that imposition.
So you've testified this morning you're really not in favor of any kind of transparency, that you don't feel they need to disclose their decision-making criteria, and you're fine with FSOC exercising broad discretion and authority basically shrouded in secrecy. So let me ask this question. Have you ever run a business?
I have not.
Ever been accountable to shareholders? You're in the Justice Department and you've been in academia. You've never run a large corporation, right?
That is for sure.
How would these corporations expect to proceed? And the hypocrisy of this whole thing is illustrated from the deposition testimony of Patrick Pinschmidt, who's the executive director. And they were asking about the different criteria that he looks at in terms of designating a SIFI. And here was his answer. He says, well, I think, again, I'm sort of doing this on the fly here. The paragraph above acknowledges that obviously, if something bad were to happen to this particular company, that would probably be factors that would impact all other companies in the same industry. Boy, that's just clear as mud, isn't it? That's his answer on his criteria when he looks at an industry.
Well, so all I'll say is corporations nor the government agencies, they don't have to disclose their internal deliberations. The key question is, what's the decision you make, and is there a basis for the decision that is made? FSOC provides that to any designated institution. It is definitely the case that the members of FSOC are, because of their expertise and because of the factors that have been given it to Congress, can come to their own conclusions about what counts as too risky and appropriate for designation and not risky enough.
And those conclusions you don't believe can be arbitrary, right? They're always well-reasoned, and there's no chance of any kind of arbitrary outcome that provides for a disparate impact on companies within the same industry.
I think the best way to measure the arbitrariness of any designation decision is to look at the basis for the decision that FSOC supplies. And in the 4 cases where it has made a designation, that basis hasn't looked at all arbitrary. Can
you sort of understand some of our concern here? Because, and let me know if you disagree with any of the following premises. We're dealing with bureaucrats that yearn to be relevant because that's how they keep a job. We're dealing with unelected bureaucrats. We're dealing with bureaucrats that really have no budget. We're dealing with a Department of Justice that has no litigation budget when they decide to fight. And it's also hard to fight the government. So can you sort of understand, and maybe you don't accept any of those statements, but if you accept any of them, can you sort of understand why this designation process gives us pause?
I worry about bureaucrats not making sensible decisions, but that's why I think that they have to be in a position to explain those decisions, and I think that FSOC's done that in this case.
So speaking of explaining their decisions, in our report we said that since they don't follow their own rules in guidance in multiple ways, Dr. Kubiak, the concern is they treat big companies in the same industry differently. Do you think that's a risk, the way they're currently proceeding?
I think the evidence that the subcommittee found in terms of second stage designations exactly goes to that point, where they found that collateral in some cases was treated as a positive, as a risk mitigant, and in other cases collateral was the worst thing that could ever happen. It was going to cause the end of the world. So yeah, they looked at the same phenomenon for 2 different firms and concluded came to exactly opposite conclusions. I think this is my story of the 2 tall firms.
And when I was in business, all I wanted to do was tell them what the rules are and treat everyone the same and let us go get about our business and see if we can make money. And those 2 factors don't seem to be in play. Mr. Pollack, one quick question. My time's running out. Professor Zaring's not concerned about the cost of compliance. Can you just speak briefly to the effect it has on the stock price and reputational risk and cost of compliance and the overall effect on the economy?
I think, Congressman, you're absolutely right about all of those. Clearly, cost of compliance is substantial and affects value. And we're looking here at these arbitrary decisions. I'd just like to repeat, the biggest arbitrary decision of the FSOC was not to look at the biggest obvious SIFIs in the country, which are Fannie Mae and Freddie Mac. They get a free pass. It's unbelievable. It's a purely, in my opinion, political decision of the previous
Gentleman's time is
administration.
expired.
Thank you.
Thank you.
Chair now recognizes the gentleman from Indiana, Mr. Hollingsworth, for 5 minutes.
Good morning. Thanks so much for all of you being here. Mr. Pollack, you continue to bring up something that disturbs me as well. When I think about systemic risk, I think about those things that are risks to the entire system itself. And what I keep coming back to is the world's largest debtor, the world's largest balance sheet are all held by institutions of this government. And I want to make sure that we're not creating adverse incentives and creating more systemic risk by government policy itself. Can you talk a little bit about maybe instead of, as my colleagues continue to say, that it's lack of regulation that created the financial crisis, instead maybe it's this distortion that's caused by government getting involved in markets. And now here we are talking about even more distortion and even unclear, unaccountable distortion.
Congressman, I think that's absolutely right. There's no doubt that part, and a very important part of the crisis, was what the government did itself in the way of promoting credit, expanding credit, driving up housing prices, and in general inflating the bubble, and many parts of the government were involved in that. But of course, in particular, Fannie Mae and Freddie Mac pushing on credit and pushing on house prices. So I say in my testimony there are two overwhelming factors often in systemic risk. One is highly leveraged real estate, and the other is the moral hazard created by government credit policy and government implicit or explicit guarantees, and Fannie Mae and Freddie Mac are that to the max, but somehow they're not SIFIs.
Right. Do you think that we have taken adequate steps thus far to remove some of those misaligned incentives or other challenges that are created in the market by through the efforts that have been undertaken in the last 7 or 8 years?
No, Congressman, I don't. And as a matter of fact, one of the biggest problems with FSOCs being even able to think about systemic risk is it has to think about systemic risk created by the government.
Right.
If you want a body to think about the massive systemic risk created by the government itself, you need a different body than FSOC.
Right. An independent body, something
Yes,
that would be able to look at all the participants, not just the private participants and the issues created there.
Yes, I think so.
Yeah. And then the second thing I wanted to talk about a little bit is some of the costs around this gray area regulation, and maybe this goes to Dr. Holtz-Eakin. You know, I used to deal with a lot of contractors, and I knew one thing for sure. When I handed a scope of work that was incomplete or unclear in any way, I knew I was going to get a wider bid because they want to protect themselves. They want to stay further away from the line. The more exact the rules of the game were, the further they could go in getting to that line. And so it's not just the immediate cost of compliance, but it's the cost of not knowing and wanting to stay further back and wanting to curtail business activities that might or might not be viewed by FSOC as problematic. Can you talk a little bit about, kind of in your view, how not only the idea of FSOC being there, but the lack of clarity around it is creating this gray area that companies are being forced to operate in, and how that might incur more cost than we even know?
I think that's a real issue. One of the things we do at the American Action Forum is we actually add up the self-reported compliance costs that agencies put to regulations. And so over the past 8 years, it was $800 billion. That's what they estimated cost businesses to comply.
Yep.
And as you point out, that's the easy part. You actually know what you have to do there, fill out paperwork and things. It's the business decisions that are affected that are the genuine economic cost, whether they are capital expansions you don't undertake because you don't want to grow and get too big and become a target, you don't hire, whatever it may be. Those are genuine losses. Yep. And once the designations are made, you now have different firms being treated differently in the same industry, and you don't have a single set of rules, and you don't have a fair competition.
Yep. And one of the big things that I've consistently pushed is by more and more regulation, especially more and more regulation from a variety of regulators, we continue to herd companies in the financial services sector into one corner. We continue to push companies to do and have the same portfolios and same exposures because that's what we want them to have. Well, we should be darn sure if we're doing that they're the exposures we want them to have, because systematic risk is really about dominoes toppling over. And the more these firms look like each other, because regulators have forced them to look like each other, the more easily issues migrate from one firm to another. So maybe you, Dr. Holtz-Eakin and Mr. Pollack could comment on that.
It's a huge irony because the basic lesson of finance is to diversify.
Correct.
And that's a very undiversified view of the universe.
Yeah. Mr. Pollack?
I think that's a great example of systemic risk created by government regulation, Congressman. Excellent example.
Right. And so my concern, again, is as we herd these into a corner, we're going to find that the risk really comes from something we didn't expect, and then we've perfectly lined up all the dominoes, ensuring that one is transmitted to the other, whether that's through mark-to-market accounting, because they all hold the same portfolio of securities, et cetera. So thank you for your time this morning. Now I yield back to the chair.
Gentleman yields back. The chair now recognizes the distinguished ranking member, Mr. Green, for 5 minutes.
Thank you, Madam Chair. Let's start with Mr. Zaring. Mr. Zaring, let's talk about this cost of compliance and juxtapose it to the cost of not finding another AIG. Could you give us some intelligence on this, please?
So The costs of compliance with financial regulation to make financial institutions safe and sound are real, but the benefits are much more real in my view. What FSOC is doing with its limited designation so far is, in my view, looking around at firms where if there was a collapse, their collapse would likely break down the rest of the financial sector in potentially unpredictable ways, and making sure that those institutions are adequately regulated. There is hard to know just how much of a benefit an avoided financial crisis is, but I think we can all presume that that benefit is extremely high, very large, and very difficult to quantify.
If FSOC, which is the Economic Disaster Prevention Agency, had had the opportunity to examine AIG, would the cost-benefit analysis be such that it would have been beneficial to find out what AIG was doing and see it as systemically important?
One of the advantages of FSOC is that it brings together every financial regulator in the government, including the newly created Federal Insurance Office and an insurance representative. The ability of all of those regulators to take a look not just at some aspect of AIG, its thrift business or some other financial activities in a particular place, but all aspects of it business, make it more likely that the regulators would have realized that AIG was writing credit default swaps in a relatively unhedged manner. And we don't know what would have happened, but we do know that AIG was a business failure and was never scrutinized holistically by regulators in the way that FSOC promises to do.
You make a good point, and I'd like for you to elaborate on it for just a moment, because there is a contention that there are other prudential regulators that would find these flaws in the system, but it didn't happen with AIG. It didn't happen with Bear Stearns. It didn't happen with Countrywide. It didn't happen with a whole host of financial industry entities. Would you elaborate, please?
That's right, and one of the things that designation is supposed to do is increase capital, which is one way of making sure that these institutions are prepared for a shock, even a shock that comes from somewhere surprising. But for the AIG story, the idea that the Office of Thrift Supervision, in overseeing its, I think, New York's chartered savings and loan, which was a very small part of what AIG did, was supposed to catch what was going on in London is, I think, naive. But on the other hand, if you get a team of rivals and a group of regulators together in a room, to the extent that they are rivals, you make catching that kind of new and creative financial businesses all the more likely.
Let's talk about proprietary information. Does that have something to do with releasing information with reference to an evaluation?
I don't think that I don't think that the institutions that the Council has considered and carefully considered would want all of the information that they provide the Council in discussing and indeed sometimes contesting their designations to be released to the public and to their competitors and to the financial marketplace more generally. Some of the things that FSOC does that some of the witnesses here seem to believe are sort of secret are the kinds of secrets that businesses want the government to keep. And I think it's responsible for FSOC to keep those secrets for the businesses they're reviewing.
Speaking of keeping secrets, there's a desire on behalf of some to have congresspersons in the room when these deliberations are taking place. Is that going to be beneficial to secrecy, and how do you think that will impact the process?
No, I don't think agencies or businesses benefit from having their deliberations, internal deliberations before a decision is rendered, being open for nitpicking or after the fact, at worst Monday morning quarterbacking. What you should do is evaluate the decision and expect that decision to be carefully articulated.
I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Florida, Mr. Ross, for 5 minutes.
I thank the chairman. Interesting, of the four non-bank financial institutions, three, of course, were insurance companies. And we've discussed today through your testimony that although there may not be that great a transparency and there might not be the best, well, rules in place in order to assess the vulnerability, there are experts. FSOC has experts. And yet, in the assessment of the SIFI designations, there are two experts, one a voting member in the insurance industry or arena, and two a non-voting member, both of whom were ignored by the designations with regard to whether these insurance companies should be considered a SIFI. Now, Dr. Holtz-Eakin, was there any discussion in this FSOC's determination as to whether these insurance companies were not properly regulated by their state insurance regulators?
No, they didn't take that adequately into consideration.
And do we not have the best form of regulation by way of our state regulators of any other system in the world?
The insurance system's proven to be very well regulated, and it's also true that these same institutions are regulated in other countries where they do business. There's an enormous amount of regulatory oversight already prior to designation.
And I guess my point is this not, this action by the FSOC in designating these three insurance companies, is it not an indictment of the state regulated based form of insurance regulation that we have in this country?
It's a mystery to me what the Federal Reserve believes it will know that a consolidated regulator in New Jersey, for example, doesn't already know about the operations of these insurance companies.
And wouldn't you say that if we're going to go this route and allow for FSOC to ignore its experts and indict a state-based system of insurance regulation, that we are essentially setting up possibly a two-tiered system, one of which that once you're designated, you're going to have increased regulation, and would that not impact the free market of insurance sale?
I've mentioned this several times now. I'm very worried about the fact that we're going to end up with an uneven playing field in financial services markets if we continue down this path.
And who's going to hurt the most?
The consumer.
The consumers are. And so has there ever been a run on an insurance company in the history of the United States?
No. One of the mysteries of this designation has been ignoring the history of successful regulation of insurance companies and also the use of scenarios which are completely unrealistic for that insurance business.
So, Dr. Kupiec, I mean, there are risk-based capital is used to assess the systemically important nature of an insurance company. Would you agree that there is no reason to deviate from the state-based system that we have today, where we've never seen a run on an insurance company, where a whole different method of assessment and analysis of your risk is used as opposed to financial institutions?
I don't think insurance merits SIFI designation. I think AIG was a special case.
It was a special case, and there wasn't even a regulator then at the time.
It wasn't part of an insurance
default swaps.
It was, and I think.
So let me ask you this, Dr. Kupiec, because you hit on it with General Electric. Now, we've discussed also the designation. And it's like going to the doctor, you're sick, but we're not going to tell you why you're sick or how you got sick or how you can get better, but we'll let you know when you're dead. Same way with SIFI designation. We tell you you're now designated, but we don't tell you how to get off. Where's the exit ramp? And it appears to me that the only exit ramp that we've been able to see in this regard has been the total sale off, like they did with GE Capital. Is that a fundamentally good method of having an off-ramp, not only for the business, but also the consumer?
No, I think if you think about my analogy, you're a well-run, growing company. This becomes a penalty for well-run, growing companies, that you might become the object of an FSOC Stage 3 review. You have no idea why. You get good marks from all your regulators.
You get no answers. You don't know why you're there, but you know that you're being investigated, and you have an obligation to your shareholders as well as your consumers. And so what do? You divest yourself from that particular operation. That's the off-ramp.
One firm did that. Whether the insurance companies, which are primarily Capital was part of GE, which has non-financial parts to it. Whether an insurance company can actually divest its way out of this is maybe a bridge too far.
At least one went to court and was successful. And I think one insurance company went to court and was successful in MetLife. And I think that what we have to do is we have to be able to allow for not only the review, but also the ability to be de-designated, the ability to have the off-ramp. I see my time is up, so I yield back.
Gentleman yields back. I'd like to thank our witnesses again for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to the chair, which will be forwarded to the witnesses. I ask our witnesses to please respond as promptly as they are able. This hearing is now adjourned.